Retail sales jumping 0.7% in March compared to the prior month. That was above expectations. And February's reading, that was also revised higher. So with this data, along with the backdrop of a strong labor market, what does this mean for the Fed's path towards cutting rates? Let's bring in Michael Darda, Roth MKM chief economist and macro strategist. Great to have you here with us this morning, Michael. I want to get first your response to what this means for the Fed.
Thanks for having me on. Look, I think this is another body blow to expectations for near-term Fed rate cuts, which have already really been backed out pretty materially. But if you remember, we came into the year and markets were expecting 6 to 7 Fed rate cuts. Now it's less than 2. And so we have several months of pretty hot inflation readings. And, now this March report on retail sales, we had some upward revisions and the numbers came in much better than expected. So I think in this environment, the Fed is simply going to be, pushing back in terms of when they would likely start to entertain any kind of a notion of easing monetary policy. The data at this point, based on the criteria they laid out previously, just does not support it.
Michael, what's your base case just in terms of then how many cuts you are expecting? Is it 2 still a sure thing, or do you think maybe it's more likely we could get 1 or potentially none at all?
Yeah, my view has been that, I do think the Fed eventually will get around to lowering policy rates and easing this year, but it's going to be back half of the year loaded. I think they're going to be very reluctant to start that process until it's really much more obvious that the economy is losing steam and that some of these stickier measures of inflation, which have been hot recently, are starting to ease, and that's going to take some time. And so what I'm worried about is if the Fed really waits until it's obvious that the economy is weakening and we don't have, that at this moment in time, they're likely to be behind the curve. And so that's really the balancing act for the Fed here. The 2 tail risks are if they wait too long and the economy turns down, then you're going to have issues with earnings. If they ease too soon or by too much, then you have a reacceleration, high inflation risk that could hurt valuations. And risk markets really aren't considering either scenario. We're basically priced to perfection here. And what do we have? Long-term interest rates are moving back up towards the cycle highs. And so that's a problem for these lofty valuations, in my view.
Michael, I wonder what you believe the earnings commentary is going to sound like this season with the Fed that may be, to what you're saying, behind the curve in some of the cutting. If we do see signs of a recession start to show up rapidly and them not be in a position to have already implemented some of those cuts.
Sure. And let me just flesh that out a little bit. I mean, if you brought someone on that was really optimistic, they'd say, well, what are you talking about? You've got incredible payroll growth, a low unemployment rate, the retail sales figures are strong, inflation's been high. But look at some of the survey data, right? We have small businesses where their hiring intentions have really fallen off a cliff. That's a leading indicator for the unemployment rate. The ISM Services Index for March showed weakness in employment 3 out of the last 4 months, sub 50. That's more consistent with payroll growth that's flat to even negative. So this weakness in the survey data against the backdrop of a long yield curve inversion, weakness in the monetary aggregates that's been ongoing for an extended period of time, that is an environment I think you're late in the cycle, and we could see surprising weakness later on in the year. We're certainly not there yet. So the earnings commentary better be good, right? Because you have equity market valuations that have ramped up above a 20 forward multiple, and that's already with earnings expectations at double-digit growth rates. So we really have priced in an environment of spectacular growth, falling inflation, the Fed being very benign. And if it all comes together, then great. But, that's what's priced in. So if we start to see surprises, then I think that's where you could get more equity market turbulence.
Michael, how big of a pullback do you think we could potentially see here if earnings don't live up to expectations, if we do see a bit of an escalation of tensions over in the Middle East, the risk that poses to the market? And then when you talk about this risk here to the downside, how much more likely is it that we're going to see this increased volatility then for maybe longer than we initially anticipated?
Well, I think if one studies market history, they wouldn't be surprised to hear me say 15 or 20% in terms of a pullback in the S&P 500 easy. And that's not even with the recession scenario unfolding. If a recession unfolds, it could be more than that. We were seeing that in the last cycle going into 2018, where equity multiples were rising, but they weren't quite as high as they are today. And bond yields were actually much lower. And we had a 10% correction and almost a 20% later that year with no recession. So with valuations at these levels, I think the risk is going to be for unexpected retrenchment in risk assets. So 15 or 20% would not surprise me at all, given this incredible run that markets have had with very, very suppressed volatility. Market history would tell us that we should be worried about surprises in an environment like that.
How should people be positioning their portfolios? Let's give folks some actionable strategy here to close out the conversation, Michael.
Sure. Well, I would just recommend not getting too excited about chasing everything that has worked so well. Consumer discretionary on a tear, tech on a tear, but the valuations there are incredibly lofty, so the expectations are already quite high. I think some of the defensive areas are worth a look. Utility stocks have really underperformed year to date as bond yields have jumped up. We recommended them last October when the 10-year ran to 5%, and they had a nice move. And now recently they've been under pressure again. But that's an area I think that is protected from the business cycle. And if you're a contrarian, I think it makes some sense to add that area to the portfolio. We're talking about retail sales, but I would be much more hesitant on the consumer discretionary sector versus staples. So I think some of these more defensive areas that are more insulated from the business cycle, that have been hurt recently by rising long rates, if you think we're late in the cycle and and recession risk is still out there, then those areas I think make a lot of sense.